Okay, we're talking amortization lengths in Canada, just all about them with Dan Patton here from BM Select Mortgages. Dan, what are the current amortization lengths that you can select for an investment property and for a principal residence in Canada?
So through your traditional bank financing is typically 30 years. There are some alternate lenders and private lenders that'll do, 35, maybe 40 years, or even interest only when you get to the private mortgage side. But excuse me, your traditional big bank is 30-year amortization. That's typically the standard. Some people take 25-year, but part of the 30-year amortization is the qualifying. When I'm running somebody's numbers to qualify, I'll actually get you a higher pre-approval on a 30-year amortization than I would on a 25. So sometimes it's necessity that people have to take a 30-year because it was the only way to qualify their deal. But a lot of people like it because it's the lower payment.
So it lowers your payment, which helps you with qualifying because they look at your monthly carrying costs.
Yeah.
But doesn't it come down to debt ratios and you're taking on more debt with the 30-year?
Well, but it's spread out over 30 years. Good question. When I'm running somebody's numbers on a 25-year amortization, they're calculating the stress test based at a 25-year amortization. So it's a higher monthly payment. Mm-hmm. When you calculate that same number on a 30-year amortization, it's a lower monthly payment, which means it's a higher pre-approval. So I can bump your numbers up a little bit more. So yeah, it's kind of weird how it works like that. You're taking on more debt, but yeah, if you take a 30-year am, you can take on more debt because you're allowed up to a certain debt service ratio. Mm-hmm. So I can creep that number up to it's a 44. I can creep that number up to 44 as close as I can. The 30-year am gives me more flexibility.
44%.
Yeah, 44 debt service percentage. Yeah, total debt servicing.
And then principal residence and investment properties, no difference. But
same thing. Some banks might limit you. Like some lenders will say if it's a rental, we only do 25-year amortizations. So on a rental, you might be limited. But for the most part, owner-occupied 30-year amortization.
What's the shortest amortization that you can get?
Well, if you're renewing with your current lender, you can, renew it maybe as low as you want. But if you're trying to move it to a new lender, most lenders have some sort of limit at 15, 17 or 18 year, like somewhere around there. They don't want go through all the paperwork to give you a 1-year amortization, put a lot of work. It's costly for the bank. Bank's a business. They're there to make money. So they want you to hold your mortgage with them for a certain amount of time.
When would you typically recommend a shorter amortization length, like let's say 15 years to someone? What situation? Is it just they're looking to pay off their home as quickly as possible?
It's a tough question. Yeah. I mean, look, again, that's a tough question because depending on what you're trying to do, sometimes having a low amortization and a high monthly payment may limit your ability to scale your portfolio. Look, from a basic theory, you want to pay off your non-deductible debt as fast as possible, right? That's just finance 101. Pay it off as fast as possible. So yeah, pay as high a payment as you can to pay off that principal debt for sure, because you can't write it off.
On your own personal home.
On your own personal
non-deductible.
Home. Yeah. Now, the argument to that would be, well, by doing so, I might put myself in a position where maybe I have $3,000, $5,000 a month mortgage payments, like whatever it is relative to the AM you're putting on with the mortgage balance left. And if I have these high monthly payments associated with my mortgage, well, maybe I can't afford to go invest. Maybe I can't afford to buy an investment property, a duplex, triplex, because I think that property is it's only going to cash flow $200 a month. And I don't know if I want to invest in a property that cash flows $200 because I can't afford it. I have this other mortgage payment I'm committed to. Well, again, what an investor might want to do is look at the overall perspective here, right? What if you can lower that owner-occupied mortgage to, maybe a $1,500 a month payment, or $2,000 a month payment, and you can save yourself a few $1,000s a month just by restretching out the amortization and saving yourself that few $1,000s. Maybe that allows you to now go buy an investment property with a little bit more peace of mind because now look, I'm not paying $4,000 a month anymore, $3,000 a month. I'm paying $2,000 or $1,500 now. I'm saving some money, so now I have a bit more cushion. I can invest in a property. I have more cash flow freed up. I can take on a few more extra costs here. Now the question becomes, what's going to pay your mortgage off faster? If you put somebody on a 10 or a 15-year amortization and don't go buy that investment property, are you really going to pay your mortgage off faster versus if you bought that investment property and maybe that investment property goes up in value over 5-10 years and you sell it and maybe you have enough equity, you can pay down your mortgage? Like, these are the things that you would want to consider when making that decision. I'm not trying to favor one or the other, but certainly I come from a invest in real estate side, so I'm trying to lower my costs so that I can take on, other investment opportunities.
That's a good answer.
Thank you.
So you mentioned that you could re-stretch out an amortization.
Mm-hmm.
When can you do that at any point? Like I'm in the middle of a term, can I just call my bank to re-stretch that amortization? Is it on renewal?
It's not an automatic, but you can call your lender and request to push the amortization back to the original contract. Now, how much impact that's going to have, look, when you're 1 or 2 years into your mortgage, probably not a big impact going from a 28-year back to a 30-year, probably not going to help offset. But yeah, you can go back to your bank and request to stretch the amortization back out to the original contract. Now, that doesn't mean if you're 10 years into your 30-year amortization that you can go back to a 30-year. It would be from your most recent contract. So if you just signed it 5 years ago, might only be able to go back to a 25-year am.
But wouldn't the bank have an incentive to have you stretch it back out because then you're paying more interest?
Yeah, well, yes, but they'll charge you a penalty to break that mortgage.
Because you're breaking the mortgage.
You're breaking the mortgage now.
Okay, so
you're
the
trying to
best you could
change the
do is,
terms.
let's say maybe you're on a 5-year term and you're 4 years into the term, and so you're 26 out of 30 years, you stretch it back out to 30 years.
Yeah, that would be where it might affect you the most.
Where it has like a more meaningful impact.
Yep.
And stuff. Okay, and then just at the beginning, you mentioned alternative lenders. Just want to be clear on the language. Are you talking about B lenders?
Yeah, B lenders. So like your Equitable, your Home Trust, there's a few other ones. Those are the two big ones.
Okay, and then they might have more flexible amortization lengths?
Yeah, I mean, they charge a premium on the interest rate on stuff like that. So there's a cost to it. So it's not as simple as like, oh, I'll get a lower payment because the interest rate's higher. So it's something that they do offer, but there's a premium to it.
Okay, and then those B lenders and stuff, what type of businesses are those?
Well, okay, so Equitable, they're a bank, so they lend their own money, and Home Trust, they're basically buying the bonds from, institutional capital.
Okay, so it's not like a traditional bank.
No, Home Trust, no.
Different. But Equitable is.
Yep.
People are making deposits
Yep.
and stuff. Okay.
Yep.
Got it.